Good afternoon, traders. This is Christian from Market Trade Group, and it is Friday, February 24th. Congratulations, you made it through the end of a week, and a pretty volatile week too. When you look at the performance for the week, which I will bring up in just a second. It was a shortened week, holiday week, but the volatility, I think, kind of felt like a full week. So that said, risk disclaimer in front of you: everything that we're going through is for information purposes only, not giving out any advice or recommendations. Everything that we're going through is for information purposes only. So we will recap the day. We'll talk a little bit about the technicals. We'll talk about some of the takeaways, some strategy as well. We'll talk about a few different things to go over. And yeah, so let's get started. By the way, you got the sun behind me. I'm kind of fighting with that a little bit. This is downtown New York City. By the way, this is the East River. If you haven't been to New York City, right at the end of downtown. This is the building that's 85 Broad Street, so it's right by Wall Street, just to give you a sense of, if you haven't picked up on my videos before. But anyway, let me get to the price action for the day, right? So obviously, another disappointing inflation report, economic report that comes out, and inflation running hotter than expected. And this is one of those situations where the word that comes to mind, when you see this inflation data come out, or this data that comes out, and for my liking and for my analysis, and a couple of things that I've talked about on the macro side, it's too big of a number. 0.6 versus 0.5 expectations. A couple things. If you are a regular viewer of my videos, you know that I've been saying that, hey, if these inflation numbers continue to move down, like we saw in the beginning of the year, where the CPI report, I think, came in at negative 0.1, we really haven't seen that trajectory stick. One of my arguments that I've made is, if we could kind of stay under 0.3 for both the CPI and the things like the PCE deflator, then we're in like a good place. And if it doesn't tick higher than that, but right now this is ticking too high, and the market is reacting to it. And of course, the macro indicators that I look at, again, I try to keep it simple. This is not fancy stuff, but I look at what bonds are doing, which you've heard me talk about bonds, almost in every one of these videos for the last couple of weeks, talking about that's a dangerous picture that's taking place with yields going higher. And then the dollar, which actually had bigger gains for the week. If you look at the last 5 days, right, here's the 5-day averages. TLT was down 0.6% for the week, but the dollar was up the most. So we could look at these charts really quick. I'll use TLT. I've been using this one a little bit more because the bonds, as I mentioned in yesterday's video, the 30-year and the 10-year did have a monthly roll, so the performance looks a little bit distorted when you look at the chart on that. But here's what the TLT chart looks like, right? So we know that we had the break of value here. And since then, it's been kind of moving down. We did take out that lower level virgin point of control. If you're not familiar with the virgin point of control, I'm not going to explain it in this video. You can go right to my pinned tweet, and you could click on, whoops, not the pin tweet here, but pin tweet here, and you could read more about the market webs, volume at price, virgin point of controls, the 80% rule, all of that type of information. So we're holding this, and I think, it's really important, I think, that we do, end up holding that virgin point of control. If we end up going down like this, we're probably going to see some more drastic, volatility, I think. And same thing when you look at UUP. UUP did not hold this. So this is the dollar. So we're getting the macro things out of the way here in the video. But I thought that this was a good place for the UUP dollar, US dollar bull ETF to kind of halt its increase. But you could see today it was a huge day, up 70 basis points. And I think the next thing to worry about, it's kind of funny because or maybe a little bit of funny is not the right word, but maybe a coincidence that the US dollar is moving up to its 200-day moving average. And the S&P and things like the Qs are moving down to the 200-day moving average. So, resistance there, and for the UUP, and support for the S&P. Also at the weekly chart, which really kind of puts this in perspective, why, again, this is a good example of why I use volume at price. The US dollar ETF got right down to the bottom of value. Again, really quickly, brief. What is the bottom of value? Well, it's a support level. Remember, this value area is based on all of the 2022 price and volume. We do put we have our own formula for this, proprietary formula, but we come up with this formula spits out a level for the top of value as well as the bottom of value, and you could see how well it comes into the picture there, right? And that happens a lot. So no surprise that it did find support, and since it found support and spent a little bit of time kind of carving out that bottom in the beginning of the year, it has made a pretty decent move, and that was up, as said, looking at the weekly performance, that was basically the only thing green up here. And this is 5-day performance, which covers last Friday. So SPY finished down 3%. Both Dow and small caps finished down 2.7%. The Qs underperformed for the week, and emerging markets really underperformed with the Chinese internet ETF down 10.6%. That's a big move in just 5 days. Again, TLT was not that bad, and gold was down another 1.4% for the week. Looking at, there were no sectors that were in the green. So again, you heard a lot, or you've been hearing a lot, I think, about cash as a position. You can get some return now for your cash, which is a good thing. I think, one of the things that I think is missed sometimes when people talk about, oh, geez, you could just earn this money right in your checking account, right? Or right in, wherever you can pick up that yield. It's, some accounts like Marcus, by Goldman, do give you that rate over, I think it's over 4% now. And of course, T-bills are one way that you can exploit, getting that yield. But keep in mind, it's still underneath the inflation rate. So you're still not winning when you when you look at the whole picture. If the inflation rate is ends up being 5-6%, okay, you're getting some yield, but keeping that in perspective, that you're not making out like a bandit with inflation higher. So yes, I do realize that there's a good place for cash, and I'm in T-bills myself, right? I'm also have a Marcus account too for my checking, which I moved out of JP Morgan, because JP Morgan won't very interesting. They will not raise their interest rates. I think they're still around 0. I just I do some banking there, but I transfer my balances out of there because they're not rewarding consumers. So a little bit of personal information there, but it pays to look to see what you're getting. If you have cash on hand, and sitting in your checking account, and you're not getting anything, then that's bad anyway. Let's get back to the market. But these are important things. So yes, there's nothing that was up in terms of my sector sheet. Consumer staples, they were flat, so they did okay. And a couple other things like agriculture and defense and materials also did decently today, down or outperforming. So here's the theme of the day, of course, inflation. I wanted to talk one more second about that. One, as I mentioned, that 0.6 is too hot, right? But I wanted to bring up a word that I haven't talked about too much in 2023, is patience, right? I mean, one of the outcomes that we did say was that this inflation may not come straight down, right? And it may take much more time than just consecutive months of going down. So, I think until we actually see it come down in some of the data points, patience is the key, not getting overexposed in this market, right? Easier said than done. But I think if you have, a game plan and you stick to it, you're faring a little bit better right now. And if you use signals like we talk about, right, with the NYSE summation index crossover, right? Right. So again, like this could be something, before I move away from this, right? This could be something like a head and shoulders pattern, right? The left shoulder, it wasn't really a left shoulder here, but maybe this is a right shoulder. It goes up a little bit before it goes down. right? So a little bit of technical analysis on a inflation report. Again, I don't have a crystal ball. Nor does anyone else, regarding what the next inflation data points are going to be. So I think we just kind of have to be prepared, and don't get and try not to get overexposed. Next, I just wanted to bring up, since we're talking about inflation and rates and all of that, did this move today? Did this in terms of what the Fed controls, the overnight rate, Fed funds rate, did this move considerably? It's not really moving too much for the month of March, right? Even though we've heard about the possibility of 50 basis points for the next Fed meeting on March 22nd, it's at 30. So it is away from 25, but it's closer to 25 than it is to 50 right now. We'll monitor to see if this changes. I don't think it's out of the realm of possibilities that we see 50 basis points. And it's really, I think, going to depend on that CPI report that we're going to get in the middle of March, right, which comes out before 322. The other thing, if you glance at some of the other rates, right, what did change was, about a month ago, we were only looking at 2 more interest rate hikes of 25 basis points. Now it looks like 3. So 1 here, 1 here, and 1 here, and it gets us to a rate right now of 5.4, right? So again, that's higher than we've seen, and I think that's the highest that we've seen so far, over the last year, that the high point of the rate could be 5.4%. Again, all things subject to change, right? This has really been changing based upon what the data is. So just like Powell has said, right, if you listen to Powell closely and objectively, one of the things that he said in his last speech is that they are going to be more data dependent, right? They are going to do what the numbers, as the numbers come out, right, they're going to make adjustments. And that's exactly what Fed Fund futures have been doing as we move along. So again, it's going to probably hinge on, another, we'll get another employment report. We'll get some other data points that come out, and of course another CPI and PPI report before 322. So that's it's important to kind of understand that. It's important to understand breadth, right? That's something that we've talked about a lot, is again, keeping it simple, using things like the McClellan summation index, right? We had a bear crossover here, we had a bull crossover here. Breadth really expanded. Since then, it's been really, really contracting, right? We measure that day by our market breadth indicator. What's different about that than just looking at advancing versus declining? It associates volume, right? And really gives you a sense of whether or not there's heavy selling pressure or heavy buying pressure. Well, we know and I think we could actually look at this, right? You could see for the month. Again, this breadth is for the whole market. It's not for it doesn't matter what the chart up here is. Why is this messed up here? Go back to the weekly here. Let's see if I could show. Yeah, so you could see for the month of February, I would like to show it on the daily chart, but this is fine too. But here's where your breadth expansion was, right? And here's where it's been weakening. So again, this is, volume at price. It's different than some of the other indicators, but sorry, it's not volume at price. It is advancing and declining with volume. All right. Now, again, it's not as bad as it was in here, but it certainly is not good, right? And we could go back to this just for a second, which again, this just looks at advancing versus declining. But you could see that we had this in here too. So far it's kind of looking like this, right? And if we start to kind of go and we can look at what's materializing here. Here's the weekly bar, here's how the week shaped up, right? So we're retracing some levels, and we started off the year inside value, which means range bound. We kind of got some names got above the value area for the year. A lot of names have stayed inside the value area for the year. So that's what the overall indices are doing. Right, we're range bound. We're not trending down. We're not really trending up. We're back at the 200-day moving average. I guess that did hold. I don't think it really matters too much whether we held the 200-day moving average or not. The 80% rule is still in effect, even though we only have 2 more days left of this year, of this month, right? Because it's a shortened, there's only 28 days in February. Now, I don't know if that's going to complete that move down there to 3905, but that's why it's not a 100% roll. It's an 80% roll. And that's been providing some good guidance. And again, what do you see here besides, whether or not the price is up, below or above the 200-day moving average? We'll look at the short-term moving averages, right? The short-term trend is now down. Qs, right? This did stop at the 200-day moving average, right? This has had better outperformance this year. So it actually looks a little bit better, but we're going to talk a lot about this. We may do a webinar for TTG members in the beginning of the month, talking about, what these value areas, you could see this is a developing value area. We have 2 more days of, as I said, we have 2 more days of February. So this, it takes all the data for the month. And it applies this, right? So this is the volume profile so far for February. So far we've got a developing value area here. This will be complete once we get those 2 more days, and then we'll have some levels to watch. But the price could open up below the value area, and again, we'll talk about that in the upcoming webinar for members. All right. So that's a couple things. Going back to today's performance, just to talk about what stood out, the energy stocks. This is kind of interesting. By the way, the VIX was only up 2.5% today. Again, the VIX is at 2160. If you want to look at this, I don't really do technical analysis on the VIX. I don't believe in it, but so far, we're not really seeing a major move higher in the VIX. It definitely perked up. We got to a high, I think of 23, right? So we could be putting in a lower high, right? Again, we need more time, right, to figure out if it is a lower high in volatility. Here's the VVIX as well, right? This also is not, it's actually a little bit higher than the December level, but it's not screaming higher. In fact, this was flat for the day, right? That's the volatility of the VIX itself. So I mentioned energy, right? Interesting place where this is, right? This has not been a outperformer this year. I still think crude needs to retake, when we look at the crude chart, it needs to retake 82. Now, it's not that far. It's kind of consolidating here. We don't know which way it's going to break. One of the things that I've been watching is, what is going on with, energy continues to be, or has been recently, when it gets to the lower range here, it ends up being a buying opportunity. Is that going to happen again? I would really watch this 200-day moving average here in XLE. OIH, which was actually showing some leadership, going back to like the beginning of February, got hit pretty hard. It's fighting to get back above the into the February value area and the 50-day moving average. So that's also something that I would watch. A couple strong areas. One of the things that I sent out over the weekend was talking about how all these auto retailers and dealerships have been super strong, right? And also some of the auto part names, right? Well, those names really got ahead of themselves. Now they're kind of coming back, right? So to talk a little bit about a couple groups that I will be watching next week, right? PAG, right? This is Penske Automotive, right? It could even fall a little bit further, right? Another name too that I think is really interesting right now is Allison Transmission, right? All of these names had this pop on earnings, or I'd say like 80% of them had this really nice move out to new highs, right? Notice this thing is coming back to the 20-day moving average. Could be a place to get involved in this name. I have not. We talked about it at the end of the day. I think there's plenty of time to get into these. I'm not rushed. GTES is another one too. This is another like transmission automation type automobile company. This is Gates International. Someone in the trading room brought this to my attention today. So I think that there's opportunities in this group. So this is Sonic Automotive. I don't like it how this broke below the moving average there. AutoZone has been another strong one, right? And then you got the shipping companies that continue to remain strong. Right? I traded a little bit of this sorry, this is not this one. I just wanted to show this one, just to kind of go over the strength, but Thinkorswim is not cooperating with me. EU, oh, there we go. I mean, these things are also doing really well. It doesn't even look like they're in, suffering any type of volatility, right? ZIM is one that you haven't heard about too much. Again, it's below the 200-day moving average, but it had a real nice day today, up 5%, and upward targets would be 25.35 and 26.84. So again, these shipping names continue to act really, really strong. One that saw option activity yesterday was EURN, which had a nice move today, up 4.2%. All right, so and then another name that's a cheap name had a huge day today. Super Microcomputer made it out to new highs today. All right, so there are some bright spots. There's not, there's not a huge amount of them, right? It's not like we saw, weeks back as we entered, towards when we got to the end of, or middle end of January and the beginning of February, right? That, if you look at there's a report that I send out, right? That's a proprietary scanner that I use, right? Which is the out of the box, right? Names that are getting out of their value area on multiple timeframes, but not super extended, right? If you look at our list, and why I didn't send out an updated list this week is because you just don't have that many names that are doing that right now, right? So here's today's list. Right, you only have a few of these names at this point. Now, again, the industrials, the materials, they're the names on the list. Melly had a nice day, after earnings, it held gains. You still have insurance names that are doing okay, but notice, going back to January, you had like 20 or 30 names. Right now, the breadth has really moved in. So I'll kind of leave it here for the because it is Friday, and I hope that you are doing something fun for the weekend. I will be doing something fun shortly. I think overall, understanding this environment and, having patience. I listened to Ben Zinga in the morning, and Dennis Dick has been talking a lot about how this market has kind of changed back to, a range market, and instead of momentum, fading big moves to the upside and to the downside, right? That's working right now. And I think that could possibly, continue to work, while, go back to this McClellan summation index, right? Until this thing starts to tick back up again, right? I think that's the market that, is the best way to kind of trade, right? Until this straightens itself out and breadth starts to pick up again. All right, guys, that's it for the Friday video. If you are not a member of Tribeca Trade Group, you could go right here. We might be we're kind of considering rolling out our part-time program again. So, for now, new members can get involved. I believe you could still sign up. You get 50% off your first month, and so it's like a part-time program. I would love to hear feedback. I would love to get some new members to kind of come in, check it out, and that's why we're still running that 50% off the first month. We won't be doing that for much longer, but I really want to get feedback to see if how people are enjoying the room and the amount of analysis that we put out, even if the market is not in good shape as we've seen it this week, right? We continue to kind of look for things like this, like an SMCI that is breaking out to new all-time highs, whereas a lot of stocks are trending down. All right, guys, have a great weekend. Thanks for watching.